A few weeks ago, Mike, you had talked about the return on a calendar spread. I'm still having some confusion as to determining what my return is on the position at a given time. Okay. I had a couple phone calls about this week too, and something about the question was throwing me off. I think one was a coaching session and one was a standard call. In a general calendar call, we're going to buy maybe a 6 to 8 to 1 year out, slightly in the money or in the money call option, delta of maybe 0.6, 0.7, 0.8. Then we're going to sell a near-term call against that position. Some investors refer to this as the poor man's covered call. But I have a problem with using that terminology because I have a feeling, and based on some of the discussions I had this week, that it throws investors off. Because if I call this a poor man's covered call, and I started out trading covered calls, as many of us did, we were only allowed to trade on level 1 trading, which gave us covered calls and maybe buy calls, and then we got into higher levels later on. When you look at a covered call profit and loss chart, you know that you're buying stock and you're selling a call, and you make the maximum return if the stock is trading anywhere above your call price at expiration, and you allow assignment to occur. Assumes, of course, you don't roll the position or make any adjustments in that case. A calendar spread has a subtly different profit and loss chart. And if you're not careful and you use the wrong filters, you can actually have a diagonal spread, or a horizontal spread would show this way, but you could have a diagonal spread buying an in-the-money call and selling an at or out of the money call that gives you two ways to lose if it wasn't set up properly. The reason why I bring this up, in addition to the question that was asked about the return, is sometimes investors do the quote-unquote poor man's covered call and they get into this position here and it doesn't match their goals. The stock moves up, they were expecting the max return in that case, but the max return didn't occur because they're over here and they're actually at a loss. So, number one, let's talk directly to the question, how is the return calculated and how can this be off to where you can lose in both ways? Let's just take a general search, and I'll just use this Corsair one here. It looks pretty decent. It's far out in time. It's 420 days. Actually, let's take this Juniper one. It's a nice August expiration, weekly August 27th expiration, 30 strike call on a stock trading at 27.57. And we can buy the April 25 strike for 265. We're in a 5-point spread with a net debit of 348. But the return is showing us 60%. Well, if I paid 348 on a 5-point spread, you might think I'm only going to get $1.52 back. That's not quite 56%. Perfect. There we go. That's much better. Okay. So, the Juniper trade. Paying a debit of 347.50, but seeing a max potential return of 250 when the stock is trading at $30 on August expiration, using the theoretical pricing models to determine what the April 25 strike would be. The return that's shown in the search tool and here on the profit and loss chart is based on the idea of selling to close that April call that would still have 235 days of time value, not buying the stock at 25 and selling it at 30. That's not what it's that in the case. We would only get 5 points back, and the profit would only be the dollar. What is that? 347. Excuse me. That $1.53 in return. Wouldn't be near this amount. This is based on that theoretical price. And you can check that very quickly on the profit and loss chart. You have to simply just scroll down to the bottom, put in our price of $30, and the near-term expiration date of August 27th. Okay, and so what would we expect if the stock moved up from its current price to $30? Well, our near-term call would expire worthless, or we'd pay 5 or 10 cents to buy it back, depending on where it is, if we didn't want to avoid assignment. And the return is based on being able to sell to close the long for its theoretical value of 598. Now, this is where the calendars do get tricky, of course. This is theoretical. There's no guarantee. If implied volatility for this April call changes, it drops down to 0.30 from 0.3225, we're going to expect a little bit less of a return. That's just how implied volatility works. That's going to be in flux depending on market conditions, fear gauge in the market, fear gauge looking out the next 3 quarters to April of 2022. But you can run those scenarios here for the calendar spreads, which I always encourage, so you can determine what you could expect if there is a shift in volatility from your short option or for your long option. How would that affect the potential outcome? Even if everything worked out, the stock was trading right at 30 at August expiration, then in that case, I might not be seeing the max profit I expected. It could be a little bit different because volatility is going to be changing and the expected price, potential theoretical price of that long option could be different in reality. That's just the nature of the calendar spreads. Now, during the portion of that conversation, one of the conversations I had, the gentleman mentioned, I think this was one by email actually, the gentleman had mentioned that I'm looking to do low-cost debit spreads, and their position was actually set up incorrectly. How can you set up a position incorrectly? Back on the default calendar screen, the initial value search and some others, we use a debit to strike difference ratio of less than 1, meaning that the net debit that I'd pay in the position total for that first short leg and the long leg that I'm buying has to be less than the difference in strike prices. So, in our case of Juniper, with our 30-25 strike at 343, or the 348 is the one we were looking at right here, if the stock suddenly shot up to $40 mid-August, and I got early assignment on my short call, my broker would likely exercise this long to buy the stock at 25 to sell it at 30, so I'd only get $5 back. I'm not able to sell to close it because I have to cover that early assignment, so I only make $1.53. But what the investor was asking is that they had a spread where they weren't using that filter, and they had actually paid a net debit that was higher than the difference in the strike prices. So let's take Juniper again. And here's our same position as before, about 348 debit, still looking at the same profit. But let's say for whatever reason, this actually cost me $6.25 to buy this call. So now my net debit becomes $578, $577 for one contract, but I only have a 5-point spread. I also see that I'm not getting as much return here because due to the high cost of that option, which is not realistic. I faked that, of course. But whenever you have one of those positions where the net debit is greater than the difference in strike prices, what you also tend to see is the position that gives you 2 ways to lose. You can lose to the downside and you can lose to the upside if it goes too high. Not like a covered call, which hit the max profit if the stock was trading anywhere above your short call strike price. In this case, the position starts to go into the loss because it wasn't set up correctly. The question from the investor, though, is how am I seeing anyway a 20% return when my debit's higher than the strike prices, so that if I get assigned, which I'm hoping for on my calendar spread, I won't make any profit? And you're right. That's why we used that filter for the debit to strike difference ratio to be less than 1. And again, the goal to me personally, and this is the comment that kind of threw me off on the statement from the email. When I enter into a diagonal calendar spread such as this, it's usually on a higher price stock that I can't afford to trade as a married put or covered call or cash secured naked put. I'm doing this on the higher price stock so I can buy the call option at 1/10 the price, maybe 1/15 the price of the underlying to control with a reasonable delta. And I'm going 6 to 8 months out, and then I'm going to be selling multiple times against it. I do not want to be assigned in this case. That's not my goal. If I'm looking for a low cost advantage to get a return on a position with assignment that's just slightly out of the money because I'm slightly bullish on the market, I'm not doing a calendar. I would most likely be using a bull call debit spread that's at or slightly out of the money. meaning my expiration dates are exactly the same. We're going to use the 25 call here. See the price here, instead of that original $4 or $5, which yes is 6 months out in time, but I'm going to be paying maybe $2.90 for this call and still getting the same 45 cents against it. Now, this might not come out to be that 72% return. Yeah, it's 88.7%. So if I was hoping to get assigned in the first cycle of a calendar spread, or in the next 20 to 30 days to get the max return, I'm using the cheapest option possible in a bull call debit spread. Why I enter a calendar is because I'm expecting to potentially be in the position for maybe 2 to 3 months for expected longer term growth, similar to a married put, but using it on a stock that I can't afford to buy as a married put or a covered call again in my portfolio. So that's just a difference of opinion, but that is how the returns are calculated. The theoretical price of your long option in a diagonal spread at the short-term expiration date. The max return occurs when it's right at the short call strike price. Why is that the maximum return? Why does it pull off after we go above that short call strike price? Why do we lose money? This is a delta effect. And commonly, you know you're buying an in-the-money call and selling an out-of-the-money call, so you probably started this position with a delta ratio of 1.6 or 1.5. What do I mean by that? It means that your delta of your long at this point is probably around 0.65, maybe 0.7. Or 70 delta if you want to call it that. And this one here is probably going to be 0.35 or maybe 0.40 or 40 delta. So the ratio between the two, you've got a higher delta on your long than you do on your short. So the idea is, the hope is as the stock moves up, you're gaining more on this long than you're losing on the short. And that's true. Then the magic of expiration day happens. And when we get near to this August 27th expiration date and the stock's moving up to say $31.50 or $32, what's happening? Well, this delta is up. Delta of my long is probably easily 0.75 now, or maybe it's 0.8 or an 80 delta, maybe even an 85 delta. While this is going to a delta of 1. No time left to expiration. It's in the money by a point or two. Every dollar it moves up here, I'm losing more on the short option, which I have to buy back, than I'm gaining on the long, because that's the magic of expiration. The deltas are either going quickly to 0 or to 1. So at near-term expiration, as we get closer to it, the delta of your short is probably higher now than the delta of the long if it's in the money. And that's why we see the trail off from the maximum return. And again, one of the reasons why I hesitate to use that term poor man's covered call, because it implies the impression that no matter what you do, as long as the stock goes up, you're going to make money. Well, we already saw one example where that didn't happen and it went negative if it wasn't structured correctly using that debit to strike difference ratio. Okay, all right, so those are two things I just wanted to cover on the recent searches and calculating and evaluating, and of course, in addition to that, checking, for lack of a better term, the return on a diagonal calendar spread or even a horizontal calendar spread using the theoretical price, and how you can see that calculation here to check the numbers to verify that's the expectation.